Yeah, so good morning, friends. Today we are going to discuss one of the most talked after, one of the most sought after ratios in the investing industry. And yes, you have guessed it right. It is the price to earnings ratio. Now, what is actually price to earning ratio? So, the price to earnings ratio tells us that how much an investor is willing to pay for every rupee earned by that company. So, let's say a stock has a P ratio of 50. So, for every rupee that the company is earning from its operations, the investors are willing to pay 50 rupees. Let's go to another example. Let's say a stock has a P ratio of 15, 1 5. So, for every rupee that the stock is earning, the investors are willing to pay 15 rupees. Now, let's say a stock has a P ratio of 100. So, for every rupee that the company is earning, the investors are willing to pay 100 rupees. Now, why is the disparity? Why a stock has a P ratio of 15 or 50 or 100, right? So, you have to think that why is that the market participants are willing to give a higher P ratio of to one stock and a lower P ratio to another stock, right? So, if we deconstruct it, the price of a stock equals EPS, which is the earnings per share, multiplied by the P, which is the P ratio. I have just tweaked the formula a bit. It is the same, right? The formula for P ratio is price to earnings. So, if we multiply the P ratio with the earnings, we get the price, right? Now, let's deconstruct it further. We know that price of a stock is EPS multiplied by P. So what you know that a company has to show earnings for its P to go up, right? Otherwise the investors, why will the investors want to bid up a stock which has no earnings? So now coming back, why are investors giving higher P ratio to one kind of stock and lower P ratio to another kind of stock? Now this has a host of things which can explain this factor. Let's say a consumer company, right? You know that largely the earnings of a consumer company remain stable. What I mean to say is when I say the earnings of a let's say a retailing company or a consumer company will say stable, it means that the participants know that this particular company can earn or let's say grow its earnings year on year, year on year, year on year. So the perception of that company to the investors is very positive. They know that even if the market somehow goes bad, the earnings will continue to come in that particular company. That is why they bid up the stock to higher prices, which means that they are giving a higher P ratio to a consumer facing or a consumer related company because of the predictability of earnings. That is why you come across companies from the retailing sector or from the consumer sector which command a higher P of say 80, 70, 90, 100 and the likes. Let's say for example Trent commands a P ratio of how much? It is more than 100 because of the predictability of earnings, right? Next, we come to the most important thing, actually, I should have told it earlier, is growth. So, if a company has growth, if the investors see that the company can grow its earnings year on year, year on year, year on year, then the investors will be willing to give a higher P ratio to that stock. That is why you see that stocks such as DMart or Trent or all those consumer facing companies have a higher P ratio. Now, let us come to lower P ratio stocks, right? Let's say a steel company. You will see that predominantly steel companies or all those cyclical companies or commodity linked companies have a lower P ratio. The reason for that is commodities or cyclicals, the nature of them moves in cycles, right? So an investor will not be able to predict the earnings for a longer amount of time, as was the case with the consumer companies, and that is why you see that the P ratio that a commodity company commands is lower, right? So first and foremost thing you have to see is whether a company can grow its earnings year on year. If that is the case, then the P ratio that the company will command will be higher. Now, which brings us to one of the most important questions is, should we avoid companies that have higher P ratios, and should we go and buy companies which have lower P ratio? Now, the thing that I just explained, that a stock, if it is commanding a higher P ratio, then there is a certain reason for that. What is the reason? It is the reason that the company can grow its earnings, or the perception among the investors regarding that company is that this particular company can grow its earnings year on year, and that is why it is commanding a higher P ratio. Now let us come back to the stocks which have a lower P ratio. The perception among the investors is that, let's say a steel company, any steel company for that matter, let's say we are in the upcycle of the steel prices. So the investors know that in this particular cycle, the earnings of the steel companies will increase, right? But it cannot be predicted, as to the cycle of commodities always change, and that is why the investors are reluctant to give a higher P ratio to all those commodity companies. So next time you see a higher P ratio stock, don't neglect it saying that I'm not going to buy it because it is commanding a higher P. There is a certain reason why that stock is commanding a higher P, and don't be very encouraged to buy stocks which command a lower P, because there is a certain reason as to why those companies are commanding a lower P ratio. Let us try to understand this with a real life example. Let's say you go to a mandi to buy mangoes, right? You see that the let's say the Alfonso mangoes, they are sold at say 300 per kgs, 300 per kg. Okay, now let's say you go to the same mandi after 2 days, and you see that the price of those Alfonso mangoes has come down to 60 rupees. Now you will be encouraged to buy that, but you have to ask yourself, why is the reason that the fruit seller is selling the Alfonso mangoes, which actually were supposed to be sold at 300 per kg, he is selling them at 60 per kg? There will be certainly some reasons why the prices have come down. The reasons might be that the mangoes have gone bad, or they have gone bad. They actually do not taste like Alfonso mangoes. There will be something negative about those mangoes which has led to the reduction in the prices of those mangoes. So next time, just keep this in mind, that all the companies or all the stocks commanding a higher P have certain advantages over the stocks which command a lower P. I hope the idea regarding the P ratio, the basic idea regarding the P ratio is clear. We'll be moving on to the next video explaining the P ratio in further detail, like what are the other factors which actually lead to stocks having or commanding higher P ratios or lower P ratios for that matter. I hope you guys like the video. Thank you so much.